Have you ever wondered how the amount of money circulating in our economy is controlled, or what levers central banks pull to influence borrowing and spending? It is a fascinating dance between banks, regulations, and the wider economic landscape that shapes our financial realities. Changing reserve requirements directly impacts the amount of money banks have available to lend, thereby influencing interest rates, overall credit availability, and the pace of economic activity. This powerful tool directly affects how easily businesses and individuals can access capital. A reserve requirement is essentially the minimum fraction of customer deposits that commercial banks must hold in reserve, either in their vaults or at the central bank, rather than lending out. When a central bank, like the Federal Reserve in the United States, decides to raise the reserve requirement, banks must hold onto a larger portion of their deposits. This action reduces the amount of money they have available to offer as new loans. With a reduced supply of loanable funds, the credit market tightens, and this usually leads to higher interest rates, making it more expensive for businesses to invest in expansion and for consumers to borrow for significant purchases such as homes or cars. Conversely, when the central bank lowers the reserve requirement, banks suddenly find themselves with more excess reserves. They are naturally eager to lend this additional capital out to earn interest, which significantly increases the supply of credit in the financial system. This typically drives down interest rates, encouraging more borrowing and spending across the economy, thereby stimulating economic growth and activity. For individuals and businesses alike, these adjustments in reserve requirements translate into real-world impacts. They can directly affect the cost of securing a mortgage, a vehicle loan, or even the interest rate on a crucial business expansion loan. When requirements are tightened, loans become notably more expensive and often harder to obtain, which tends to slow down overall consumer spending and business investment, potentially cooling an overheated economy. If they are loosened, credit becomes cheaper and much more accessible, which can actively fuel growth, increase employment opportunities, and boost overall economic momentum. It is truly one of the more direct and potent ways a central bank can influence the financial system's liquidity and the broader economy's health. This core mechanism is also intricately tied to the fundamental economic concept of the money multiplier. Every dollar that a bank lends out can, in turn, be deposited into another bank, which then lends out a portion of that new deposit, creating a powerful ripple effect throughout the financial system. The money multiplier vividly illustrates how even a seemingly small percentage change in reserve requirements can lead to a much larger and more significant change in the overall money supply circulating within the economy. For instance, if the reserve requirement is 10%, a $1 initial deposit could theoretically generate $10 in new money through the continuous lending and depositing cycle of the banking system. Understanding this relationship reveals the profound leverage central banks possess in steering the economy. This specific tool, reserve requirements, is a cornerstone of what economists refer to as conventional monetary policy, operating alongside other vital tools like setting the discount rate and conducting open market operations. By grasping how central banks strategically adjust reserve requirements, you gain a much clearer and deeper understanding of their objectives: to manage inflation, to stabilize financial markets, and to promote sustainable economic growth. It helps to explain why borrowing costs fluctuate, why investment decisions are made, and ultimately, why the economy experiences periods of acceleration or deceleration, offering crucial insight into the sophisticated mechanics of our interconnected financial world.